Hi guys, welcome back to Compound and Everything. For those of you that are new here, my name's Chris and this is the channel dedicated to all things investing, finance and business. Now, before I get into this video, I think it's time I updated you guys on the progress of our public portfolio. I know in my 1000 subscriber video, I mentioned the idea and literally hundreds of you commented and emailed me saying you were keen. So, in saying that, if this video gets 2,500 likes, I will open a public-facing, completely transparent stock market portfolio and post updates on this channel every single month. There will also be a percentage of that portfolio that you guys will control. All that is between us and this idea coming into reality is 2,500 likes on this video. So feel free to do your part and tap that like button. Anyway, moving on from that, in this video, we're going to be discussing two of the most divided and intensely disputed stocks on the ASX right now, Zip and Afterpay. First, I'll give you guys a head-to-head comparison of their books, and then we'll move into discussing their future prospects and if I think the buy now, pay later space is in a bubble. Anyway, let's get this one started. Now, when it comes to Afterpay, there is no doubt they've been increasing revenue year on year for a while now. In fact, their most recent report looks to be heading towards another increase of 100% or more. When we move on to return on equity, however, you can see a slightly different picture, which is a return of just under negative 8%. And a free cash flow or a negative cash flow of $1.50 per share. Currently, post-raising, they seem to be sitting on just over $700 million in cash, and they have a book value of just over $3 per share. Moving on to Zip, we're going to see very similar types of numbers. We can see that revenue is also showing an increase of roughly 100% or more, which although is due in part to their internal expansion, is definitely boosted significantly via their acquisition of QuadPay. Now, when it comes to return on equity, we can see that like Afterpay, they are running at a deficit. They are also sitting on a book value of roughly 40 cents per share. So what do these figures really mean? Well, firstly, it's fair to say currently valuations are not representative of current operating activities, meaning that these companies are extremely expensive from a fundamental perspective. In saying that, I'm sure that's not exactly breaking news for you guys. The real question is, why are investors so excited and why do they believe that this share price is going to keep increasing? So to start answering that question, we're going to move on from the books and take a look at the share price and what kind of return you may have achieved if you bought these companies on their day of listing. So when it comes to Afterpay, their current share price at the time of recording this video is roughly $52. So a $10,000 investment in 2017 would have landed you around 3,380 shares in this company, which now would be worth roughly $175,000. Not too shabby at all, considering it has been only 3 years since their official listing. Then if we look at Zip, a $10,000 investment in late 2015 would have netted you roughly 26,400 shares in the company, which would now be worth just over $161,000, which, all things considered, is also a great return for half a decade. I mean, it's easy enough to say that either way right now, if you had bought those shares at that point in time, you'd be a pretty happy camper. But that doesn't really address the question here, which is, why are these guys still growing and do I think they're currently experiencing a bubble? Well, although there isn't a certain answer to that question, I will try and explain why I think this could go either way. Now, my first concern with the buy now, pay later space in general is their moat. I mean, it essentially doesn't exist. What is stopping you or me from gaining funding and replicating their exact model? I mean, the numbers do seem to show that clients using one of these services are more likely or already have started using the other. And that isn't surprising at all when you consider that some of these clients, not all, but some of them, cannot obtain credit via other means. So traditionally, there is absolutely no moat in place here. And yes, it can be argued that Afterpay has an advantage via their brand reputation and existing customer base. But then again, so did Kodak and Blockbuster. The problem with these types of offerings is yes, they are incredible ideas, but normally end up being superseded over the long run. So let me give you an example of what could be a fatal blow to the growth of these companies long term. Say you're banking with Commonwealth Bank, or any bank for that matter, and tomorrow they decide to provide clients with an account. That account has a limit of, say, $1,000, and anything you buy within that account will mimic the features of Afterpay's repayment system of 4 equal payments over 4 fortnights. Well, all of a sudden, this unique offering from a handful of companies is now the new bread and butter. It would essentially be a race to the bottom via incentives and feeless structures. And I can guarantee you that the banks wouldn't be the ones to lose that battle. But let's say it's not a bank that decides to copy Afterpay. Let's say it's an existing provider that already has millions of clients. This might be a company like Shopify, who has over 1 billion orders placed on their system so far. Now, companies like Zip and Afterpay have piggybacked off these types of services. So not only could Shopify remove the competition directly, they would also be instantly stealing market share. And look, I know this is all what ifs and a complete guessing game, but that's the problem with this sector. Everybody is just hoping that things will keep on moving forward as they have for the past few years, which is highly unlikely. So what is my prediction moving forward, and do I think this is a bubble? Well, firstly, when it comes to Zip and Afterpay, I think these guys will still have above average growth over the next little while. But remember, they are already trading at valuations that take into account most, if not all, of those gains. So I guess that leaves me in answering the question of if I think this is a bubble or not. And the short answer is yes. I think right now, new investors are getting caught up in a mixture of two things. First is they are predicting the best possible outcome and not taking fundamentals or probability into account. And I think the second reason is fear of missing out. People see these two companies and think, man, if I'd bought this last year, I'd be set for life. Surely it will just keep going up. This is a 101 textbook case of being in bubble FOMO territory. And you don't have to look too far back in the past to see cases like it, especially when it came to the 2017-18 cryptocurrency bubble. I do hope you guys enjoyed my opinions on the buy now, pay later space. I'd love to hear what you think about this in the comment section below. Before I end this video, I did want to mention to all of those who aren't aware that I have started a podcast called Stocks on the Rocks. Once every month or so, I will do an episode of that podcast, which is going to be dedicated completely to answering your questions. So feel free to type them in the comment section below in any of my videos, and I'll add them to my list. Oh, and if you're interested in checking out the podcast, it'll be uploaded here on YouTube, or you can find it on any of the major podcast providers by searching Stocks on the Rocks. Now, of course, feel free to leave a positive in-app review if you enjoyed the content. It seems to be the only way to sort of gain a little bit more exposure when it comes to getting your podcast out on those platforms. Now, of course, if you haven't already, consider pressing the subscribe button and the little notification bell next to it. Also, feel free to pound that like button. Remember, 2,500 likes means this channel will open a public-facing portfolio. Anyway, guys, I appreciate you watching this video, and I'll see you on my next episode. Cheers.